Welcome to the deep dive. Today, we're digging into a really interesting company, Abaxx Technologies.
Yeah, they're operating in a fascinating space.
Right. Our mission here is to give you the definitive shortcut to understanding what they're doing. It's complex. They're trying to, well, essentially rebuild some of the core plumbing of global finance.
That's a good way to put it. They sit right at this intersection, between highly regulated commodity markets on one side
Okay.
and some pretty breakthrough digital asset technology on the other.
And that intersection, that combination, is really the core of it, isn't it?
It's everything. I mean, technically, Abaxx is a Canadian tech company. It actually came about through a reverse merger back in late 2020.
Right.
But its real power, its structural advantage comes from two very different but deeply connected pieces. First, they own 90% of a fully regulated commodity futures exchange and a clearinghouse. That's crucial. Both licensed in Singapore by the MAS, the Monetary Authority of Singapore.
Okay, so serious regulatory backing there.
Absolutely.
Hmm.
And second, they've built their own proprietary digital infrastructure. And this isn't just some quick startup tech. It's built to operate at the highest standard of institutional trust. Think clearinghouse level trust.
Okay, let's try and unpack this big idea then.
Yeah,
Because the vision, well, it's ambitious, hugely ambitious.
definitely is.
And frankly, some of the talk around it, the speculation, is pretty massive. The sources we looked at suggest Abaxx is going after these enormous global inefficiencies. Think multi-trillion-dollar problems. Things like slow collateral management, assets being tied up, and this issue of opaque price discovery in commodities where you don't really know the true price.
Right, until it's too late sometime.
Exactly. And one source even described their high-level goal as building the Apple equivalent ecosystem for global finance.
That analogy pops up a few times.
It does, and it suggests not just like a new app or service, but a whole integrated operating environment, a full stack.
Yeah, and I think that analogy works, but only if you understand the regulatory muscle behind it.
Yeah.
Apple, they control the hardware, the OS, the App Store.
Right, the whole experience.
Abaxx is aiming to control the clearing, the settlement, and the identity layer for institutional finance. That's the parallel. So, for you listening, we really need to focus on how they combine these parts. We'll break it down into three main pillars.
Okay.
First, that high margin, really high barrier to entry exchange and clearinghouse business. That's the foundation.
Got it.
Second, the tech breakthrough. Their unique approach to tokenizing assets, they call it full digital title or FTT. It's pretty radical.
FDT.
Yeah. And then third, the underlying identity architecture that holds it all together. That's known as ID++ how.
Exchange, FDT, ID++ app.
Got it. Let's dive into that foundation first, the exchange and clearinghouse, because you said it's the linchpin. It absolutely is. So Abaxx operates this futures commodity exchange and, crucially, the highly regulated clearinghouse licensed by MAS in Singapore. And you're right to emphasize this is not some, fringe crypto startup playing at the edges.
No, this sounds like deep, complex, core financial infrastructure built for institutions.
Precisely. And the clearinghouse part,
Yeah.
that might be the single most important detail here. A clearinghouse is essentially a specialized, highly regulated financial bank.
Yeah.
It acts as the central counterparty to every single trade on the exchange. It guarantees the performance of the trade, manages all the risk, and basically ensures the solvency of the entire market.
So it's like the ultimate guarantor, the risk manager for the whole system.
Exactly. Think of it as the economy's primary risk meter. Its existence is what allows huge institutions, banks, trading houses to trade massive volumes without having to worry about the specific counterparty risk of, whoever's on the other side of their trade.
Okay. They only face the risk of the clearinghouse itself.
Correct. And that clearinghouse is regulated to an incredibly high standard. It has to be rock solid.
And that regulatory moat, getting that license, it sounds massive. We hear about fintech startups wanting to disrupt finance all the time, but they almost never start here. Why is it so hard to get these licenses, and what does that difficulty mean for profitability?
Well, the difficulty comes down to three things, really. Time, capital, and trust. The ABXX team spent about 7 years.
7 years, wow.
7 years. Just developing the systems and going through the process to get the necessary licensing and regulatory approval from MAS in Singapore. It's not just filling out forms.
No, I bet not.
It's this deliberate multi-year grind. You have to satisfy incredibly complex capital requirements, demonstrate bulletproof risk management procedures, prove your technology is resilient enough to handle major market shocks. The barrier isn't just paying a fee, it's earning sovereign trust.
Okay. And the payoff for getting through that 7-year gauntlet, this is where the business model gets really interesting, right? Like,
Absolutely.
hmm
Because entry is so incredibly difficult, futures commodity exchanges are often cited as the single most profitable subsegment within the entire global exchange business.
most profitable. Why specifically futures commodities?
It's this amazing combination of really high fixed costs up front,
Yeah.
that 7 years, maybe $250 million spent on licenses, tech, legal.
Mm-hmm.
But then, once it's built, the variable costs are incredibly low. Running one extra trade electronically costs basically nothing.
Ah, okay. High setup, low running costs.
Exactly.
Yeah.
And that drives profit margins way up, often into the high 60s, low 70% range. It's largely an oligopoly market.
Right.
The big established players benefit from powerful network effects. More traders attract more liquidity, which attracts more traders.
Right, a virtuous cycle.
And they often compound profits at rates like 16% to 22% annually, sometimes for decades. That scarcity, that difficulty of entry, is why analysts estimate the licenses alone are worth something like $200 million to $250 million USD.
Just the licenses.
Just the licenses. It's a foundational asset. It proves you've met that incredibly high bar.
That makes total sense. It's like a toll booth on a super busy highway, but you can only build a new toll booth if the government says yes and you prove you've got Fort Knox levels of security and capital behind you.
That's a great analogy.
And speaking of pedigree, the people running this, the sources are clear. This isn't their first rodeo. They're not new to building these kinds of highways.
No, not at all. They really seem to have the DNA of market builders, people who understand infrastructure. The CEO, Josh Crum, for instance, he's ex-Goldman Sachs. He was a senior commodity strategist and executive director there.
Okay, so he knows commodities inside out, knows where the money flows, and importantly, where the inefficiencies are.
Exactly, especially in the physical commodity space, which is key to their strategy.
And then there's the exchange's CCO, Joe Raya. That name jumped out too. Also ex-Goldman, head of global commodity futures there.
And even before Goldman, Raya was apparently instrumental in building out parts of the big existing exchanges, like CME and NYMEX.
Wow. Okay, so they've literally built the competition before.
That's crucial context. When you're aiming to take on the 200-pound gorillas, is one source
They
put.
have like CME and ICE.
You can't just throw some software engineers at the problem. You need people who understand exactly how those massive, complex systems are built, where their potential weaknesses or overlooked opportunities lie, and critically, how to attract that huge institutional flow of capital they currently command.
Right. You need the veterans.
You need the veterans who know how to spot the real market inefficiencies and build new markets from first principles, not just, making existing products slightly better.
And their location choice, Singapore, that also seems very deliberate, strategic. Why Singapore specifically? Why not London, New York, Dubai, Hong Kong?
Well, Singapore offers a few key advantages. First, it's seen as a truly neutral international financial center. It's deliberately independent from the traditional Western hubs, New York and London.
Okay, neutrality matters.
It does, especially for global commodities. Geographically, it's right in the center of Asia, which is by far the largest global hub for actual commodity trading and demand, energy, metals. Everything flows through or to Asia.
Right?
And the other huge factor is regulatory stability and, crucially, property rights. When you're talking about contracts that might involve physical delivery of high-value assets, think gold bars, for example, Singapore offers this unparalleled level of security for things like vaulting and legal jurisdiction. That appeals massively to global players who want neutrality and rock-solid legal ground.
Okay, so foundation built on regulatory bedrock, experienced teams, strategic location. Given all that muscle, they must be targeting some major pain points. What specific inefficiencies are they actually going after in the physical markets?
They're basically attacking a fundamental flaw that's emerged from the increasing financialization of global commodity markets over the last few decades.
Financialization. What do you mean by that exactly?
Well, the big incumbent exchanges like ICE and CME, they evolved over time to primarily prioritize paper trading.
Paper trading. So contracts that don't actually involve moving the physical stuff.
Exactly. Contracts that almost always close out purely financially. They're settled in cash based on some index price without physical delivery ever taking place or only in very rare circumstances. The vast majority of volume in many existing contracts is just used for hedging risk or for financial speculation, not for actually arranging the delivery of barrels of oil or tons of copper.
Okay, hang on. Can you break that down a bit more? What's the real difference between a futures contract that settles in cash versus one that, like ABAXX is pushing for, requires physical delivery? And why does that cause a price discovery failure? Give us the simple version.
Okay, sure. So imagine a futures contract for, say, widgets that only allows cash settlement. The price of that contract isn't based on someone actually needing widgets next month. It's based on an index, maybe an average of prices reported by a few brokers or quotes.
Right, an abstract number.
Pretty much.
Yeah.
Now, the problem is, if the people who actually need the widgets, the buyers of last resort, or the factories that actually produce the widget, the sellers of last resort, if they never have to show up and physically exchange the goods at that contract price.
Then the price can drift away from reality.
Exactly. The index price can get distorted. It gets discovered based on paper speculation, hedging flows, maybe even manipulation, not necessarily on true physical supply and demand or scarcity. The actual real-world cost of getting that widget delivered might remain opaque, hidden, until someone really needs it and has to pay up in the physical market. That gap, that disconnect, that's the price discovery failure.
And this isn't just some academic issue. It has huge real-world financial consequences. The sources use the LNG example, liquid natural gas.
Yeah, the LNG example is perfect.
Wow.
It shows exactly how this opacity locks up capital and creates massive inefficiency. Imagine a big energy company. Maybe they have a $1 billion cargo of LNG on a ship. They need to use that valuable cargo as collateral, maybe to manage their trading risk or just get some working capital. But because the existing benchmark prices for LNG, like the JKM index in Asia,
Yeah.
because they're historically volatile
Mhm.
based on that potentially opaque index pricing and settled financially, the banks just don't have a reliable, liquid, standardized benchmark they fully trust to assess the true risk of that billion-dollar cargo accurately.
So the bank gets nervous, doesn't trust the paper price.
Right. They lack transparency. So what do? They impose a massive haircut on the loan. That producer, with their $1 billion asset, might only be allowed to borrow, say, $600 million against it.
Wow, so $400 million of value is just stuck unusable.
Yes, that $400 million is dead capital. It's locked up purely because of inefficient price discovery
Wow.
and the lack of a trusted, physically backed benchmark. It represents pure systemic inefficiency.
And while that obviously hurts the producer, the sources point out that the big incumbent banks actually kind of benefit from this lack of transparency, right?
Oh, absolutely. They have huge research teams, sophisticated models. They can often estimate the real risk better than the producers or buyers can. This opacity allows them to charge extra fees, capture wider spreads on financing, and basically maintain control over that lending process. Abaxx's core strategy is to blow up that opacity by creating transparent, physically settled markets.
Okay, so that's the core market strategy. Building new markets where physical delivery is the standard, where the buyer or seller of last resort has to show up if needed. This forces the market price to actually reflect the real-world supply and demand for the commodity.
Precisely. They're trying to re-anchor finance to the physical world.
And they're moving fast. The sources say they already have over 50 contracts listed for trading, with 10 active futures contracts launched, including those big focus areas: LNG, carbon, nickel sulfate for batteries, lithium carbonate 2, and gold kilobars.
Yeah, and we should probably look at a couple of those key benchmarks to see the strategy in action. Take LNG first. It's cited in multiple places as potentially one of the most important commodity markets globally going forward, maybe even a top 10 global derivative market. It's absolutely essential to the global energy grid, especially with the energy transition.
And Abaxx is the first mover here with physical delivery.
First, to offer a truly physically deliverable futures contract suite. And they didn't just launch one generic contract, they launched 3 specific contracts tailored to key regions. One for the U.S. Gulf of Mexico, one for Asia Pacific, and one for Northwest Europe. Those started trading in June 2024.
And this is a direct challenge head-on to those established, financially settled indices like JKM in Asia, which you mentioned generates maybe over $100 million in revenue.
Direct challenge. The idea is to offer a better mousetrap, a price benchmark that producers, consumers, and traders can actually rely on because it's tied to physical reality. And what kind of traction are they getting?
Yeah, is it working? Are people trading it?
Well, the traction seems to be accelerating, maybe faster than some expected. One source mentioned that by November 2025, ABXX LNG volumes had already reached about 7.4% of JKM's reported volume.
7.4% already. That's significant.
It is. And apparently this is happening before they've even secured full FBOT approval, that's Foreign Board of Trade approval from the U.S. regulators.
Ah, okay. And FBOT is important because...
Because it would essentially open the floodgates for the massive U.S.-based trading firms and banks to easily access and trade on the ABAXX Singapore exchange. Right now, it's harder for them.
Got it. So the underlying logic is, as ABAX's physical volumes grow and prove reliable, eventually even traders using JKM will be forced to use the ABAXX contracts for better risk management, a more accurate hedge.
That's the thesis. Physical reality eventually wins.
Okay, second big opportunity, gold. And here they're really leveraging that Singapore location, aren't they? The sources use this phrase, they're trying to create a liquidity black hole for precious metals. Sounds pretty dramatic.
It does sound provocative, but there's a logic to it. The current global gold market for big institutional players is actually kind of broken. It's fragmented.
How so?
Well, you've got New York primarily handling the futures market through COMEX. Then you've got London handling the big spot market, the physical bars, through the LBMA.
Okay, two different centers, two different types of markets.
Right. So if a major bank or fund wants to arbitrage between those two, buy futures, sell spot, or vice versa, they're dealing with different legal jurisdictions, different market rules, often different settlement times. And sometimes they even have to physically ship gold bars across the Atlantic.
Seriously, that sounds incredibly inefficient.
It is. And to make it even messier, the standard bar sizes are different. COMEX uses a 100-ounce bar. But the major Asian trading centers, where a lot of physical demand is, they primarily use the smaller kilobar.
Ah, okay, so just managing inventory and delivery is complex.
Very. So Abaxx comes along and says, forget all that friction. They offer gold futures and spot take delivery, all in the same location, Singapore, under the same legal jurisdiction. And crucially, using the same bar size, the smaller, highly liquid, Asia-preferred kilobar.
Okay, so they centralize everything. Futures, spot, delivery, legal framework, bar size, all in one place.
Exactly. That centralization and standardization creates massive potential efficiency gains. It makes arbitrage cheaper, faster, less risky. The theory is that liquidity will naturally flow towards the point of least friction, the most efficient venue. Hence the black hole effect, it just sucks liquidity in.
Got it. And this market building strategy, it also extends into newer areas like environmental assets, right? Carbon markets, and this idea of graded commodities.
Yeah, they're active in the voluntary carbon markets, offering contracts for things like CORSIA-eligible credits for airlines and forest protection credits. They seem focused on high-quality, standardized contracts there.
Anticipating that quality will matter more as these markets mature.
Right? Anticipating that these high-quality voluntary credits might eventually become fungible or feed into mandatory compliance markets down the road. But the really interesting forward-looking piece is graded commodities.
Graded commodities, what does that mean?
It's about embedding verifiable data, metadata, directly into a commodity's digital record, tracking its entire supply chain history.
Tracking things like?
Things like its carbon emissions footprint during production and transport, its water usage, maybe confirming the absence of forced labor in its supply chain, stuff like that.
Why is that suddenly becoming so important?
It's being driven by a wave of new global compliance requirements. We're seeing new legislation rolling out or being proposed in places like the EU, Canada, Australia.
What kind of legislation?
Rules that demand much greater transparency in supply chains. If a company imports steel, for example, they might soon be legally required to prove the carbon footprint of that specific batch of steel.
Wow, okay, so traceability becomes mandatory.
Exactly. And graded commodities, as Abaxx envisions them, provide the mechanism to do that efficiently and verifiably. It allows producers who can prove their materials are ethically sourced, or low carbon, or meet whatever standard is required.
To instantly prove it and potentially get paid more for it.
Precisely. They can command a premium instead of being lumped in and priced at the margin set by the dirtiest or least transparent producer.
Yeah.
It potentially turns what looks like a compliance headache into a competitive advantage. And Abaxx is aiming to build the market rails for this whole shift.
Okay, so if the exchange with these physically backed contracts and graded commodities is the high margin foundation, then the proprietary technology they've built seems to be the potential catalyst for that massive Apple ecosystem vision.
The tech enables the next level.
And it seems to all boil down to solving this problem of settlement friction. You mentioned earlier, right now, moving money or assets after a trade happens. It's slow, T
Mm.
plus 1, T plus 3, sometimes even longer.
Mm-hmm.
And that delay ties up huge amounts of capital, slows everything down. One source estimated it impacts something like $94 trillion in annual value transfer. ABAX's ultimate goal here is T plus 0 settlement, instantaneous.
Instant settlement, zero delay. And that's something no traditional futures commodity exchange has ever managed to achieve systemically.
Why not? Why has T plus 0 been so elusive, especially for big institutions?
Well, this is where the conversation really shifts from just market mechanics to legal technology and trust.
Huh.
The fundamental reason T plus 0 has been basically impossible for large regulated institutions comes down to two things: counterparty risk and legal finality.
Okay, break those down. What about current digital solutions like stablecoins, Tether, USDC? Why don't they solve it for banks?
Good question. Popular stablecoins, they look like digital dollars, but they fundamentally fail institutional clients on those 2 points. First, they are single issuer products,
Yeah.
meaning your entire holding relies on the solvency and integrity of one company, Tether or Circle or whoever issued it. That's massive counterparty risk concentration. If that single issuer goes bankrupt,
What happens to the money, the tokens?
well, crucially, under current law, the token holders likely don't have a direct property right to the underlying assets if they even exist and are properly segregated. They become general creditors in a bankruptcy proceeding. Your funds are stuck, potentially for years, tied up in legal battles.
And for a major bank, or especially a clearinghouse that's dealing with potentially billions in margin calls every single day, that kind of bankruptcy risk is completely unacceptable.
Totally unacceptable. A single failure like that could trigger a systemic crisis, a domino effect. Plus, there's the other issue the sources mentioned: privacy. Large institutions simply will not transact trillions of dollars on public blockchains where competitors or regulators or anyone else can potentially track their every move.
Right. Lack of privacy is a deal breaker.
Absolute deal breaker. So that's the friction, that's the problem that ABAXX claims their FTT full digital title technology solves.
Full digital title. Okay, how does it solve it?
They approached it differently. They focused on solving the critical legal problem first. How do you attach actual enforceable legal title to a digital asset? They use what they sometimes call digital checks.
Digital checks.
Yeah, it's an analogy. They apparently achieved this using 5 different cryptographic systems working together. And importantly, they deliberately structured it to avoid the single issuer counterparty risk you get with stablecoins.
So it's not a stablecoin model.
Not a stablecoin.
Yeah.
FTT functions more like think of it like a self-verifying digital cashier's check.
Yeah.
Or maybe a digital bill of lading for assets.
Okay, let's spend a moment on this legal difference because it sounds absolutely critical. It's the core breakthrough, right? What is the fundamental difference for an institution holding, say, tokenized money market funds via FTT versus holding a stablecoin if the entity behind the asset goes bankrupt?
Okay, this is the crucial distinction. It boils down to property law versus bankruptcy law. If you hold a stablecoin issued by Company X and Company X fails, you typically have a claim against Company X in bankruptcy court. You're an unsecured creditor. You don't own the underlying dollars or assets directly. The tokens are essentially IOUs.
Got it, an IOU.
With FTT, the way ABAXX has structured it, the actual legal title, the proof of ownership, is cryptographically bound to the token itself.
Yeah.
And it's backed by a specific legal framework they developed, presumably in coordination with regulators like MAS. So if the asset issuer, let's say the provider of the money market fund that got tokenized to go bankrupt,
Yeah. What happens to my tokenized MMF unit?
the institution holding the FTT token still maintains a direct, legally enforceable property right to that underlying asset share. The ownership right represented by the token is designed to survive the bankruptcy of the issuer.
Whoa, okay. That's huge. That's legal finality and bankruptcy remoteness.
That's exactly what institutions require. That level of certainty allows them to treat these tokenized assets as truly their own, even in a crisis. That's what they need to move trillions instantly and confidently.
And this legal finality, plus the built-in privacy FTT offers, shielding trades from prying eyes, that's the core differentiator that unlocks T plus 0.
That's the claim. So what's the operational impact then? If you have T plus 0 settlement with legal finality,
Right. What does it actually let institutions do differently?
it allows for a radical reduction in collateral inefficiency. Remember our LNG producer example, the one with $400 million in capital locked up because the bank applied a huge haircut.
Yeah.
With FTT, potentially, that LNG cargo itself, or tokenized gold sitting in a vault, or tokenized money market fund units.
Hmm.
These assets could potentially be instantly tokenized using FTT, And crucially, they could then be used immediately as high-quality liquid assets, HQLA.
HQLA, that's the gold standard for regulatory collateral, right? What
Well,
banks need to hold.
exactly.
Yeah.
It's the best kind of collateral for meeting regulatory requirements, especially for clearing margin at a place like ABXX's own clearinghouse. So when institutions can move HQLA instantly, T+0 instead of waiting days for settlement,
They unlock massive amounts of capital that was previously tied up.
precisely. Instead of parking cash for, say, 3 days just waiting for a trade to settle, they can use that tokenized asset immediately for margin, freeing up cash for new trades, lending, or other obligations. It's about making capital velocity much, much faster.
And the potential scale here, it's kind of mind-bending. The sources estimate this type of technology, FDT, is needed to unlock what they call the $42 trillion assets on network AON market potential.
Right. That $42 trillion number refers to the estimated global pool of HQLA, things like government bonds, high-grade corporate debt, potentially even gold, and other commodities that could, hypothetically, be tokenized and moved instantly if the right, trusted, legally sound infrastructure existed.
And ABEX is eyeing a piece of that. How would they monetize it?
Well, beyond just transaction fees on the exchange, they're apparently projecting significant revenue potential from charging a small annual fee, maybe around 5 basis points. That's 0.05% on the value of these assets on network managed through their system.
5 basis points. Sounds tiny, but on trillions.
On potentially trillions. Even capturing a small fraction of that $42 trillion pool implies enormous recurring revenue streams. That's where the really big valuation numbers start to come from, which we can talk about later.
And critically, this isn't just a theoretical white paper anymore. You mentioned pilots.
Yeah, the sources point to FDT pilots focusing specifically on tokenizing gold and money market funds, two key forms of institutional collateral slated to begin in Q4 2025.
Okay, so that's a very concrete near-term catalyst to watch. Does the technology actually work in the real world with real institutional money?
Exactly. Q4 2025 looks like a key moment for proof of concept.
All right, so underpinning this whole FDT revolution and really the entire integrated ecosystem vision, you mentioned a third pillar, ID++ way, the identity layer.
Right, ID++ attribute. They call it the trust stack. And this isn't some add-on. It's foundational. It's the technology platform that underlies everything else. And again, it was apparently built from the ground up to meet the single highest standard they could aim for, the standard required by a regulated exchange and clearinghouse.
So maximum security, maximum compliance from day one.
That seems to be the philosophy. It focuses on digital identity, ensuring that legal finality we talked about, and crucially doing it with built-in user privacy.
Why is digital identity so pivotal here? It feels like we jumped from physical commodities to legal tech for assets now to like self-sovereign identity. How does it all connect?
It connects because you simply cannot tokenize and instantly settle a real-world asset worth potentially billions without absolute, verifiable, auditable certainty about who owns it, who is trading it, and who is legally responsible for it at every single step. You need ironclad identity verification.
Okay, that makes sense. You need to know who you're dealing with, especially at institutional scale.
Exactly. And it's not just me saying it. Larry Fink, the CEO of BlackRock, he's been quoted multiple times saying that cracking verifiable digital identity is the critical bottleneck holding back true, large-scale tokenization of traditional assets.
So if you don't solve digital identity robustly, you can't really solve instant trustworthy settlement for a bank or a clearinghouse.
Pretty much. ID++ is Abaxx attempt to solve that institutional know your customer, KYC, and know your business, KYB, problem, which is vastly more complex than just, verifying an individual for a retail app.
So how does ID++ approach identity differently then, compared to the standard process today, like maybe uploading a scan of your passport and a utility bill to some website?
It uses concepts from decentralized identity, or self-sovereign identity, combined with verifiable credentials. Think of it like this. Your identity, or your institution's identity, becomes like a secure digital wallet. And in that wallet, you hold cryptographically secured, legally verified credentials. Think digital versions of your passport, your driver's license, maybe your professional certifications, your company registration documents, your brokerage license.
Okay, so digitized versions of real-world credentials.
Right. But here's the key difference. Instead of handing over copies of the actual documents, the passport scan, the license photo, to every single platform or counterparty you interact with.
Which creates a massive security risk, right? All those copies sitting on different servers waiting to be hacked.
Exactly. Huge data breach risk. With ID++ SO, the user, whether an individual or an institution, controls their wallet and controls who gets access to verified facts derived from those credentials and, critically, how much access they get.
Okay, explain that. If I'm a big trading firm needing KYC to trade on the Abaxx exchange, I don't actually send them my CEO's passport details.
Correct. Instead, you would use your ID++ wallet to grant ABAXX permission to cryptographically verify specific facts about your identity, facts they need for compliance. For instance, the system might allow ABAXX to verify, yes, this entity possesses a valid brokerage license issued by regulator X, is legally registered in Singapore, and its authorized signatory is person Y, without ABAXX ever needing to see or store the underlying documents themselves, like the actual license image or the signatory's personal date of birth.
Wow, okay, so it's selective disclosure, minimal disclosure.
Selective, minimal disclosure of verified attributes, not the raw data. It's a profound shift. The user, the institution, retains control over their own sensitive data and manages their own information risk.
And the sources suggest this capability, verifying credentials without handing over the data, is seen by some as a potential breakthrough even bigger than blockchain itself.
Well, the argument is that it creates a fundamentally new layer of trust and security online. The end goal they seem to be aiming for is a system where having multiple verified credentials, say, having 10 verified credentials in your wallet creates a much stronger cryptographically guaranteed proof of identity than relying on just, 3 scanned documents emailed somewhere and stored insecurely.
Right, more data points, verified independently, build stronger trust.
Exactly. It manages the information risk for the institution doing the verifying, and it manages the identity theft and privacy risk for the individual or entity being verified. The fact that the system is apparently patented and, again, built to that highest possible regulatory standard, the clearinghouse standard. That's the claim differentiator.
Okay, let's tie this back to that Apple ecosystem analogy again. How do ID++ and FTT together support that kind of full-stack vision?
Well, think about it. Abaxx seems to be building a kind of closed-loop operating system for institutional finance. Apple controls the OS, which manages identity and user access via Apple ID, right? And they control the App Store, the delivery mechanism for value. Abaxx looks like they're building ID++ as the operating system for institutional identity and risk management. They're building FTT as the legally compliant, instant payment and asset transfer rails. And they have the exchange as the marketplace where value is discovered and trades are executed.
So integrating custody, clearing, exchange, identity, and tokenized collateral all into one system.
That seems to be the grand vision. And by doing that, they are explicitly aiming down the road to potentially bypass much of the existing slow, complex, and expensive infrastructure used today, like the SWIFT network for cross-border institutional transfers and FX.
So functionally replace SWIFT, at least for their ecosystem participants.
That appears to be the long-term strategic ambition. They manage the financial and systemic risk through the regulated exchange and the FTT collateral movement. And they manage the critical information and identity risk through ID++O. It's designed as a complete integrated system built entirely around institutional trust from the ground up.
All right, this brings us to valuation. And we definitely need to approach this carefully because the numbers mentioned in the source material, well, they jump around wildly. Let's start with the most conservative baseline valuation, the value of that high barrier foundation.
Right, that's the starting point. You look at comparable established exchange businesses,
Yeah.
CME Group, IC.
Yeah, the giants.
Their market capitalizations are huge. Somewhere in the range of $83 billion to $93 billion USD. Now, Abaxx's current market value, as we speak, is often framed primarily around the estimated value of its licenses, that $200 million to $250 million USD figure we discussed.
Okay, so the market today values it largely based on that regulatory asset and the potential of its early contracts.
Mostly, yes. And the team, the vision, the tech build out so far.
But the more bullish sources, the analyst reports, they suggest a massive potential disconnect between that current valuation and the future possibilities. How do we get from, say, a few $100 million to the first major potential step up, maybe that $10 billion to $20 billion range mentioned?
Okay, that interim bridge, that first big leap in potential value, is built almost entirely on successfully capturing significant market share in those key physical commodity benchmarks.
So winning in LNG, winning in gold.
Yeah, exactly. Analysts project that the exchange and clearinghouse business alone, if successful in launching just a few major benchmark contracts, could potentially become a $10 billion to $20 billion company in time.
And that's based on?
It's based on achieving that benchmark status becoming the go-to contract for key commodities like LNG and gold. Each one of those successful benchmark contracts is independently estimated by analysts to be potentially worth somewhere between $1 billion and maybe $5 billion USD in terms of the enterprise value it could support based on the recurring high-margin transaction fees it would generate.
Okay, so if they manage to capture, say, 30% or 40% of the global market volume for physically settled LNG and they successfully launch that efficient gold contract ecosystem, they could justify that $10–20 billion range based purely on the exchange business, using the profitability ratios of CME and IC as comps.
That's the logic behind those projections, yes, based on comparable exchange multiples.
What's the biggest hurdle, then, in getting there? Is it the incumbents fighting back, regulatory capture, or just the sheer inertia of getting big institutions to change their established workflows?
It's probably a mix of all three, but inertia is likely the biggest factor day to day. The incumbents, CME and ICE, they don't necessarily need to innovate aggressively sometimes. They can rely on existing client relationships, the stickiness of established liquidity pools.
Yeah, the nobody gets fired for buying IBM idea, but for exchanges.
Kind of. Abaxx's strategy seems designed to bypass that inertia head-on. They're not just trying to slightly improve an existing CME contract. They're creating entirely new physical markets, like physically delivered LNG, that address fundamental inefficiencies the incumbents have arguably ignored or benefited from. And then, crucially, they're layering on the FDT technology to make those new markets instantly more efficient for collateral management.
So the aim is force adoption through demonstrably superior efficiency and better risk management, rather than just incremental improvements.
That appears to be the play. Offers something fundamentally better and more efficient for a specific, painful problem.
Okay. Now we get to the really explosive, more speculative valuation potential. The sources suggest that if, and it's a big if, the full digital title, FDT technology, launches successfully and gains widespread adoption, then some analysts and commentators see potential valuations ranging from $50 billion up to even $100 billion.
Right. This next massive step up in potential valuation is based almost entirely on successfully penetrating that $42 trillion assets on network market we talked about.
The market for tokenized HQLA.
Exactly. If FDT actually becomes the de facto standard or even a major standard for institutional collateral movement chosen because of its legal finality, its T+0 settlement speed, its privacy features, then it creates an incredibly powerful, sticky network effect. Because once institutions start using it for one asset class, or with one counterparty, the incentive grows to use it for all asset classes, with all counterparties, to maximize those efficiency gains. They'd be building a business model that starts to look less like just an exchange, and more like the global payment networks Visa, MasterCard.
Ah, okay. Charging a very small fee, those basis points, on a colossal volume of asset movement.
Precisely. A few basis points on even a fraction of $42 trillion is a truly gargantuan, high-margin, recurring revenue stream. That's the maths that gets you into those $50, $100 billion potential valuation discussions.
And then we hear the really, really speculative numbers. Some sources mention whispers or possibilities of Abaxx potentially reaching north of $1 trillion market cap. What on earth would need to happen for that kind of outcome to even be conceivable?
Okay, yeah, that kind of number requires basically everything going right, plus incredibly rapid, widespread global adoption. It assumes they fully capitalize on what some estimate might only be a 2-year first-mover advantage with this specific combination of regulated clearing and legally robust FDT.
So near total success.
It implies not just deeply penetrating that $42 trillion AON market, but potentially displacing significant chunks of the existing institutional infrastructure for things like cross-border settlement, custody, FX.
Yeah.
Leveraging that ID plus trust stack to onboard a vast number of global financial institutions into their unified ecosystem. It represents the absolute ultimate success of that Apple ecosystem vision, effectively controlling the new operating system for institutional value transfer globally. Highly speculative, obviously, but that's the theoretical ceiling some are looking at.
Okay, so bringing it back to Earth slightly, what does this all mean for the immediate future? We need some tangible milestones for you, the listener, to watch out for. What are the key near-term catalysts expected, say, between now, Q3 2025, and maybe the first half of 2026?
Well, probably the single most critical catalyst to watch is the proof of concept for FDT. We're looking for those digital title pilot transactions for gold and money market funds. Those are slated for Q4 2025, according to the sources.
Right. That's the moment the tech has to prove it works with real institutional money moving across the system.
Exactly. Does it work as advertised? Does it meet institutional, operational, and compliance needs? That's key.
And we should also expect to see continued expansion of their actual commodity contract offerings on the exchange.
Absolutely. We should expect the launch of additional precious metals contracts, probably silver, maybe a more robust gold spot contract to complement the futures, building on any success they see with the kilobar contract.
Yeah.
They might also push into more base metals needed for the energy transition.
And on the regulatory front, anything key there?
Getting that FBOT approval from the U.S. regulators is a big one. That would significantly open up access for U.S. trading firms, potentially dramatically increasing liquidity and trading volumes on the Singapore exchange. That's a major potential catalyst for the core exchange business.
And finally, that underlying identity stack, ID plus plus S, needs to start rolling out commercially too, right?
Yes. The sources mentioned they're planning to roll out their console applications, things called Messenger, Sign, and Drive, which are apparently built on ID++, leading up to a commercial launch of something called Abaxx One, designed for enterprise compatibility, probably in the first half of 2026.
Okay, so it's a sequenced rollout designed to prove the whole value chain.
That seems to be the plan. ID++ secures the identity and the collateral, which enables FTT to move it instantly and legally, which supports more efficient trading on the exchange. It's all designed to work together.
Wow. Okay, this has been a really intensive, but I think incredibly revealing deep dive. It's clear Abaxx Technologies isn't just another exchange, and it's definitely not just another fintech or crypto company.
No, it's trying to be something different.
Right. It's attempting to build this full-stack financial architecture. And critically, it's building it on that incredibly difficult high-margin foundation of a fully regulated clearinghouse that seems key. And it's poised to try and monetize two massive simultaneous trends.
Which are?
First, capitalizing on this potential shift back towards needing reliable physical commodity pricing, think LNG, think those graded metals for supply chain transparency. And second, trying to monetize what seems like an inevitable institutional shift towards needing legally compliant, efficient digital asset collateral, which is where FTT comes in.
I think that convergence is absolutely the core takeaway. They're taking that highly regulated infrastructure, which grants them institutional trust and legitimacy, and they're fusing it with what they claim is breakthrough, legally compliant digital title technology, FTT. And that combination, that fusion, is specifically designed to solve the deep-seated institutional trust problems, things like legal finality, privacy, counterparty risk mitigation, in a way that, frankly, most of decentralized finance has struggled to achieve for the world's largest, most regulated financial players.
Right. They're not asking institutions to adopt crypto laws. They're trying to eat up the technology to fit existing stringent financial regulations.
Exactly. Meet the institutions where they are, legally speaking.
Okay, so we have to leave you, our listener, with one final, maybe provocative thought to chew on. One that kind of extends beyond just global commodity trading or financial plumbing.
Go for it.
If this cryptographic verification of identity, ID plus plus EO, combined with that concept of legal finality, if it can be built and deployed successfully for arguably the most demanding client imaginable, a global commodity clearinghouse that has to guarantee billions, maybe trillions in assets daily, what happens when that underlying ID plus plus technology potentially scales out? Think about the age we're entering, the age of agentic AI, deepfakes, constant data breaches, where proving who you are securely and privately is going to become paramount.
The huge challenge.
Imagine having the ability to grant specific, limited, verifiable access to your identity credentials, proving you're qualified for a job, proving you're over 18, proving you own something, controlling your own data, managing your own information risk, instead of just handing over your entire digital self to every website, every app, every counterparty.
That capability could become incredibly valuable.
Right. Could that kind of user-controlled, cryptographically secure identity verification become one of the most essential services in the world, defining the future boundary between our privacy and our interconnectedness online? Something to definitely mull over as you contemplate the next frontier of digitized finance and identity.